Hi, I'm Mark Hebner, President of Index Fund Advisors, and welcome to IFA TV. Today, I want to talk about the topic of index funds. What are index funds? Who defines index funds? What are the various definitions of index funds? All right, so I'm going to start off with a handful of definitions from various sources about what an index fund is, because believe it or not, there isn't one definition. It was one of the first things that kind of surprised me as I started digging into the literature about this industry. There really are no official definitions of a lot of investment terms, and it's up to a manager, an advisor, to kind of set their own definition. So because I'm index fund advisors and because I wrote the book Index Funds and I own the website indexfunds.com, I decided I'm a pretty good person to write the definition. And so here's what I came up with. An index fund is a mutual or an exchange traded fund that follows a set of rules of ownership that are held constant regardless of market conditions. So if we have the world going through a global financial crisis, does the manager of that fund change the stocks they're going to own? No, they stick with the same set of rules that they had before there was a financial crisis. And if on the other hand, FANG stocks are going through the roof, have gone through the roof is the right way to refer to it. But as you know, in our industry, people like to say going, but it's only gone. Do we change our index and start throwing in a bunch of FANG stocks because they've had great returns in the past? The answer is no. You have a set of rules. And if you're buying US large cap value stocks and those stocks do not fit in with those set of rules, you don't change and start adding in other companies that would break the rule, basically, right? So what does Russell, for example, say about an index fund, and how do they define it? Well, we looked it up, and here's what they said. They said an index is a basket of securities selected on specific criteria and aims to track a particular investment theme, such as a market, a region, you got international emerging markets, right? An asset class, large value, small cap, large cap, a sector, an industry, or a strategy. And then they add generally, the goal is to accurately represent the risk return goal of that theme. FactSet, which is another industry entity that provides facts about investments, they say that index funds are those funds that are fully rules-based as opposed to those with investment processes that rely on human judgment. Which brings us to maybe the opposite definition. What's active management? Well, active management is an investor, could be a manager of a fund, or could be an individual who tries to time the market or pick stocks with the goal of identifying stocks or even markets that are mispriced. In other words, the securities are undervalued, overvalued, and there's an opportunity to exploit the other side of the trade and end up with a market beating return, otherwise known as an alpha in our industry. So active managers are stock pickers and market timers. That is very different than a set of rules that are adhered to regardless of market conditions. So let's talk about some of those rules. I'm going to start with Dimensional Fund Advisors, US Small Cap Value Fund. And here's some rules that they use to basically decide which securities go in the fund. That fund targets the smallest 10% of domestic stocks by market cap. So what do? They take all the stocks, they rank them by their size, and the bottom 10%, wherever that line is, are the stocks that meet their rule, follow their criteria, are similar characteristics to the other ones, and therefore those are a buy. If the stocks move up into the 11th percentile, then the stock no longer qualifies for the rules and they need to sell it. The selection process includes securities down to 10 million in market capitalization, which provides the coverage of microcaps as well as small caps. Within this part of the market, the fund guidelines focus on the lowest 35% stocks that are screened by a price to book ratio. So that is a value metric. Remember, this is small cap value. So we need a set of rules for both. Now, because of Dimensional's research, they've also realized that they would like to exclude companies that are small cap value that have low profitability metrics. That's actually a gross profit divided by assets. There's a little more to that, but that's a simplified definition. And they also want to exclude companies that have relatively aggressive investments back into the business. So what I've just described to you is really what's called the Fama-French 5-factor model for equities. And here I have a definition and even the formula for that 5-factor model developed by Eugene Fama and Kenneth French. So those are the professors. Eugene Fama won a Nobel Prize in 2013, and his co-author and colleague Kenneth French, the two of them have been working together for I don't even know how long, 30 years probably, in doing research and coming up with information that ultimately led to these set of rules and these factors that have pretty clear definitions and actually indexes they use to do this research in the first place. So for example, if they're looking at the size factor, you can see here the definition. It's the return on a diversified portfolio of small stocks minus the return on a diversified portfolio of big stocks. In other words, what they call the size effect. There's also a value effect here, which is the difference between the return of a diversified portfolio of high and low book to market stocks. So they use the rule of and the definition of the book value divided by the market value. It's just another measure of value. So anyway, they have a whole set of rules. That is the foundation for Dimensional's funds. And in particular, when you're looking at something like these US small cap value. Well, there's also a large cap value. It's got a little different criteria. It targets the largest 90% of domestic stocks by market cap size. And it focuses on the lowest 30% of stocks by a price to book ratio. So this tilts the portfolio towards those stocks of basically more value. All right. And they also add more profitability to this fund. They started doing that back in about 2012. So those are a couple set of rules. Now, those set of rules don't precisely match the benchmark that Dimensional uses in their prospectus, partly because the benchmarks, the Russell indexes, the Russell 1000 value, the Russell 2000 value, those Russell indexes are a little bit different than the criteria that Dimensional uses. And so you wouldn't call them an exact index because the prospectus benchmark is not exactly what they're doing within the fund. So what are they doing? Well, they're more closely following the Dimensional indexes, which have a foundation in the research done by Eugene Fama and Kenneth French and the 5-factor model for equities. By the way, there's also a 2-factor model for fixed income, which helps drive their fixed income investments over at Dimensional. I want to now talk about what goes on in these Dimensional funds and compare the mutual fund performance with a portfolio of these dimensional indexes. As investment advisors, we do have access to these dimensional indexes. And so I constructed a portfolio of dimensional indexes, and you see them listed here. So for example, a dimensional large cap index, a dimensional US large cap value index, and a US small cap and a US small cap value index, international value. There's a whole bunch of dimensional indexes here. And so we put those together in portfolios in the same percentage allocation that we would use when we construct our dimensional mutual fund portfolios. And so one thing to do if you want to see if these dimensional funds are tracking these dimensional indexes is to compare those over extended periods of time. So we looked at a 19-year and 6-month period, pretty good sample size. And probably the most common for portfolio for people is a 60% stock and a 40% bond allocation. So let's look at a portfolio 60 in this particular allocation. And so we see here that if we were to look at the return and the risk of a dimensional index portfolio, we see here over this period that the annualized return was 5.88%, and the standard deviation was 10.06. Let's round that off to 10.1%, okay? And so that's utilizing these indexes that you see down here. Now, instead of looking at the index portfolio, now let's look at a portfolio of the funds that are really set up along similar rules of ownership as those of the indexes. And let's look at the risk and return data for that same 19-year and 6-month period. Well, here we see portfolio 60 had an annualized return of 5.59 and a standard deviation of 10.1. Basically exactly the same. Instead of 10.1, if you recall, the index was 10.06, rounded off to 10.1. But how about the return? They're different. Well, here's why. The dimensional fund has a fee taken out of it. And so if we take that fund return of 5.59 and we go over to the IFA fee page, you'll see that the blended expense ratio of a portfolio 60 is 0.29. And if I then take 5.59 for the mutual fund and add back the fee of 0.29, you get exactly 5.88. So adjusted for fees, the blended 15 fund portfolio from Dimensional exactly to 2 decimal points matches the blend of dimensional indexes over this 19-year and 6-month period. When we think about the rules of construction here, and we see that the rules of construction within the dimensional indexes come closer to the actual fund, then we see that this is a better comparison. Thanks for listening, and I'll see you next time.